You placed a perfect trade, textbook setup, and the market did the opposite, took your stop, then reversed, and went exactly where you expected. That's not bad luck, that's by design. And by the end of this video, you'll understand who's doing this, why they're doing it, and how to stop being on the wrong side of it. Most traders think markets move because of news or indicators like RSI or patterns on a chart, but institutions don't care about your RSI. They're not using the same tools you are. Markets move for one reason: liquidity. Price goes where the orders are. In this video, I'll show you three things: what liquidity zones actually are, how order flow really works, and why the market moves the way it does. No indicators, no guessing, just how price actually works. Every move in the market comes down to one thing: buy orders and sell orders. If aggressive buyers dominate, price goes up. If aggressive sellers dominate, price drops. Simple. But here's what most traders don't understand. Big institutions can't just enter trades whenever they want. They're moving massive capital. If they enter at market, they move the price against themselves. So what do? They create the conditions to get filled. They need liquidity, and that liquidity comes from you. Your stop loss becomes their entry. Now this is where it gets interesting. Where do most traders place stops? Above previous highs, below previous lows, around support and resistance. Everyone is taught the same thing, which means everyone places stops in the same areas, and that creates clusters of liquidity. These are called liquidity pools, and institutions target them. They push price into those zones, trigger all those stops, they could collect that liquidity, and then reverse. That spike you see, that's not random, that's a stop hunt. The market went exactly where it needed to go to fill large orders. So the real question is, if you know where they're hunting, why not trade with them instead of against them? Here's a deeper layer. Price doesn't move based on indicators, it moves based on unfilled orders. When price moves aggressively, the market tends to return to these zones. That's why price often comes back to levels that look random but aren't. There are areas where institutions entered and where they're likely to act again. The sequence is simple. Liquidity gets taken, structure shifts, then the real move begins. Once you understand this, you stop reacting to the market and start reading it before it moves. What we do isn't typical trading. We don't rely on retail indicators. We use institutional grade data from sources like Bloomberg and Thomson Reuters. We work with a limited number of serious clients focused on scaling capital, not experimenting. If that aligns with you, check the link in the description and message me on Telegram. Markets don't move randomly, they move toward liquidity. And predictable traders become that liquidity. Don't be predictable. If this changed how you see the market, subscribe.